Hey everybody, welcome to today's video. We're going to have a lot of fun with this video today. This is an interesting topic because we're in a kind of a situation where this is really beginning to look very attractive for life insurance. So I'm going to make the case for whole life insurance today, and I hope you enjoy it. Thanks again for tuning into my channel, and if you're your first time here, I provide all things on financial planning, life insurance, estate planning, helping business owners, individuals, incorporated professionals, doing a lot of different kinds of subjects for a lot of people, so I hope you enjoy it. Let's get into this. I think you're going to really love it. So really the topic is really about, is it the right time to start investing in whole life insurance? I'm going to share with you exactly why I think it is. So let's talk about a few things that we're going to go over today. We're going to be talking about whole life insurance. Is it the right time to invest in whole life insurance? How whole life insurance works, how you generate tax-free income using whole life insurance, and how do you have access to your life insurance. That kind of makes sense, right? You'd want to know that you have access to it and that it's not going away. So let's just back up a little bit and explain the difference between term insurance and whole life. Some people find it very confusing about what is whole life, or it's commonly also known as permanent life insurance. So let's look at this illustration here, and this should help you out pretty easily. On the left, we have term insurance. Term insurance is what it is. It's a temporary coverage. Typically, you see it being purchased in blocks of 5, 10, or 20 years. You can get also term insurance to age 100, but typically you see it 5, 10, or 5, 10, or 20 years. It's designed to cover off a temporary need. A temporary need, like you've taken on a lot of debt all of a sudden, or you've got a newborn baby, you're starting a family, and you want to cover off early death, so you've got life insurance. You want to make sure that whatever that need is the lowest cost insurance you can get. So that's kind of the purpose for taking term insurance. Now, term insurance has no cash value, so it's kind of like renting a policy. I like to think of it to be able to give an analogy or a comparative, and that would be like car insurance. Car insurance, you pay your monthly premium or your annual premium, that's your cost to you, and it only is useful to you when an accident happens. In this case, term insurance, the accident is death. There's no other use for it other than that. You pass away, the death benefit gets paid to whomever you choose. Whole life insurance, same kind of principle. It's life insurance, but here it's called permanent coverage because it's not for a temporary need like 5 to 20 years. This is going to be with you for your whole life. So there are higher premiums because that means that higher premiums means what do you pay every month? And the reason for that is because you're going to be asking the insurance company to cover you as you get older. So the cost, the risk to the insurance company increases as you age. So there's actually, internally, there's a cost, right, going up. Think of it like a small curve that's rising up. That's the cost of the insurance as you get older. And so using whole life insurance, the cost or the risk to the insurance company gets greater and greater and greater, but they don't increase your actual premium, the amount of money that you pay every month. That is constant. So that is kind of an interesting concept in that a little bit of a risk for the company, but they're giving you this awesome thing, and that is cash value. So the money that you're paying into the life insurance policy, part of it goes to pay for the cost of insuring you, and the rest of it gets invested in a pool of money. I'm going to get into that in a minute. And that money gets invested, and you get paid an annual dividend. They've been paying annual dividends for like 140 years, never missed any dividend payments. So it's been a fairly secure investment. And so that's why they say that's why you own the policy, because you're going to have it the rest of your life. So that's a pretty quick explanation of term insurance and whole life. If you have any questions, please put your comments below, your questions below. I'm happy to answer these questions. Also, another thing that I want you to pay attention to is where you're getting the information from. If you're getting information from US videos or documents, it's a completely different story in life insurance in the United States. There, you pay tax on the growth of the investment. Here, you do not. So we are, it's a pretty unique product in Canada, and I have to tell you, you're blessed to be able to have a product like this, to be able to legally hide your money in insurance. Let's get into how this works. So typically people think life insurance should be used for, look at this beautiful picture, right? You got a young family, newborn baby, and both these parents are thinking, I have to protect this child. We've got to raise this child. But what happens if we die too early? Well, let's make sure that money is not the problem for them. And so they get life insurance so that they can ensure that the survivors carry on with the same standard of living that they did prior to the person's death. That's a responsible way of looking at life insurance, isn't it? But that's a typical kind of reason why you would use life insurance. But what if you're thinking about it in a different way? Because it's not just for that. What if your problem is that you have a punishing tax problem? That's where whole life starts to be something very, very interesting. Because now you have, so what is that punishing tax problem? You are an individual who has money in a non-registered account, so not your tax-free savings account, not your RSPs, because that's a tax-free for the tax-free savings account, tax-deferred for RSPs. But what if you have investments in a non-registered account, or if you're a business owner and you have an incorporation, you've got a corporate account, you have to pay tax on that investment. And it's punishing for small business owners, and I have videos up here, you should check those out, where I talk about passive income tax, that is a crushing, punishing tax for business owners. It almost makes them think like, why bother? Why should I leave my money in my corporation and invest it, because I'm just getting punished with income tax? If you're an individual and you're a high income individual, high income earner, and you've got money in investments and you're paying at a high marginal tax rate to use that money, this guy is exactly what's happening to you. You have a punishing tax problem. So life insurance starts to begin to make sense for that kind of scenario. So let's figure out how to use it. So life insurance is really an alternative asset class. You're talking here about having typical investment structure, right? You've got equities, you've got fixed income, you have some real estate. But in this case, you could have whole life insurance. So it is a portion, a wedge of your total investments. But really, what you want to use is your fixed income portion, or your non-registered investment, but the fixed income portion, the one that is getting the lowest rate of return, and it's the highest income tax, right? Bond, for instance, if you've got bonds, if you've got GICs, those have the lowest types of income, but it has the highest tax rate on them. So it's not really a great investment, but it is from a point of view of making sure that your money is protected, because bonds, as you know, don't fluctuate the way equities do during really bad times. So one of the strategies would be to take a portion of your fixed income money and start to transfer that year over year into a whole life insurance policy. So let's share with you how that would work. Here's a great illustration of how whole life insurance works. There you are on the left. You're either an individual or you're a business owner, and you've got money there in that satchel, and you're being taxed heavily, and you're thinking, where can I put this money that I'm not going to have to pay any income tax? So you say, you know what, I'm going to talk to an insurance company, get an insurance contract, and deposit that money into the life insurance. So that's what you did in year one, and everything's good. That money is now inside of the life insurance policy. You're getting about 5% rate of return on your money, and you're not paying any income tax. You don't report anything to Revenue Canada here. It's totally legal. That's just the way the insurance tax rules are written, that money held inside of a whole life insurance policy is a tax-free environment. I love it. This is so awesome. So now year two comes along, and there you are with your money again. But what happened over here on the right-hand side? The insurance company said, well, look, you've had your money with us for an entire year, and we've invested that money. We did a really good job of managing our business and predicting a whole bunch of different things, and we're now going to pay you a dividend. And they're going to send that annual dividend right back into your life insurance policy. Now you have more cash in your life insurance policy, and that you also pay your second year, and you have more cash in your life insurance policy. You just continue to do that year over year over year. You can do that for a short period of time. You can talk to the insurance company and say, what is the minimum amount of time that I can fund deposit money, because I can't see myself, 10, 20, 60 or 50 years doing this. Or you can say, I want to have it a specific time. So you can say, I only want to do this for 10 years or 20 years. That is, you kind of work that out with your insurance professional to figure out what's the best timeline, or you can pay your entire life. It's up to you. But the whole thing here is you're taking money from a taxable environment, from your business, for instance, and you're not paying any personal income tax. You're just transferring it from your corporation to a life insurance policy. I've got another video, check up here. You'll see some videos about how that kind of works with businesses. But essentially taking money from a taxable environment to a non-taxable environment, and you have access to that cash anytime you like. And there are so many different ways to use it. You can just withdraw it. You can use it as collateral and borrow against it. And then that loan becomes tax deductible. It's just awesome. I love it. It's one of the best strategies. But anyway, I digress. I don't want to get too excited about it. So I want to continue and share with you. So why is this important to you? Well, interest rates are going up. But what does it matter? So what interest rates are going up? Well, the reason for that is interest rates are predicted to, we're going to have, this is the word on the street so far, is 5 quarter-point hikes in 2022. Maybe it's going to be 4, maybe it'll be 3, but everyone is expecting that the rates are going to go up. If we do get 5 quarter-point hikes, it's going to go to 1.5% by the end of 2022. Here's what all the banks are predicting right now. If you look here, all the 6 banks, here is 2022. They're all predicting at least 1% increase, some 1.25% increase in the overnight lending rate. So that's not what you're paying, right? That's what banks are paying to the government to borrow money from the government. But that translates to us in when we go to borrow money in mortgages and different loans. So this means that a full 1%, all the banks are expecting at least 1%. Now, Scotiabank sees an even more darker time on the horizon. They're seeing 1.25, but look at year 2023. They're seeing it going up another full 1 percentage point. If you look at the 5-year Bank of Canada yield, it says 1.5% in 2021 it ended, and it's now at 2.05%. That means that things are going to become more expensive for us. But why is this really important to you? What is the connection between rising interest rates and the reason why you'd want to buy life insurance? Well, the reason why this is important to you is because as interest rates go up, insurance companies' profits rise. In fact, for about every 1% increase in interest rates, insurance companies make about $1 billion of profit. That profit then is partially translated into the dividend scale, and the dividend scale is what makes up that dividend that's paid to you every year inside of your life insurance policy. So if interest rates are going up and insurance companies are making money, your policy will not be, should not be, at 5%. It's going to start to now pay out at a higher dividend with each year that goes by. This is really important to you because when I first started back in 2004, interest rates or the dividend scale was 8%. And it's just declined with everybody all the way down to 5%. And it stayed there from 2017 to 2022. So you can imagine the people that wrote insurance policies in 2004, and they had their insurance projections saying, we're going to have this much money in a certain period of time, but the dividend scales started to go down, down, and down, and have remained there historically low for a long period of time. But now there's an interest rate reversal happening. We have interest rates that are about to go up, and not up in a little way, go up 1 to 2% over the next 2 years. So this is now a condition where it's going to be useful for you to be investing in life insurance because the dividend scale will likely go up now, not down. Okay, why is whole life insurance such a sound investment? Well, because of the low volatility and the predictability. Now, I use that word very carefully because, you know, in investing, you don't want to say it's predictable. But just look at this graph and this illustration. This will explain what we're talking about. That magenta line, that's your S&P total S&P TSX total return. So you can see from 2011 to 2020, it went up, but it was painful over all those years, going up and down, up and down. If you are invested in the market, you understand that. You know what it was like. The 10-year bond, you see it going gradually down from 2011 to 2020, just gradually going down and down and down. And then you see the life insurance. This is the dividend scale. This is what you get paid every year into your policy. You can see it was going down, but marginally just sliding a little bit. But look at the volatility, like zero volatility there. So this is a good example of how you can take some of your money that's in a slow rate of return, like a bond, fixed income, right, and move some of it into life insurance. Because if you're getting, 5.5% or 6% in a bond, we'll say, but you're having to pay 50% tax on that, then that's not really that great, is it? So the idea here is taking that same rate of return, but putting it into something where you don't have to pay any income tax on it. Okay, wow, I look at this slide and right away my heart and the breath left my lungs, because remember this in 2008 and 9, I remember it. It was a day unlike what I've seen back in, I remember when the dot-com, I was in Nesbitt Burns at the time, and it was a really riveting time as well. But here you have the stock market. This is the Toronto stock market in 2008 and 9 and 10. You see that in the decline of negative 35%. And what do you notice about this? And that is that as the market is declining, it took a long time for people to get back to where they were prior to the market collapsing. But anyone that had a whole life insurance policy in that year got an 8% dividend paid to their insurance policy. And why is it that way? Because every year prior to the next year, usually around November, insurance companies will say, for the next year, we're going to pay this percentage. And it's usually like the same as last year or within a quarter percentage of their current dividend scale. So no matter what happens next year, they've already committed the dollars to pay everybody that's got a whole life policy, no matter what happens. So in that year when the market went down negative 35%, everybody that had whole life got 8%. So you think about from a point of view of recession proofing your portfolio or part of your money in that way. It is easy to do using life insurance because of the sustainability of the actual life insurance. Okay, so that makes sense. Okay, strap on your thinking hat for a second. I'm going to share with you something that's going to blow your mind. You're going to say, what is going on? Every time I did this presentation at seminars, I was afraid they were going to start throwing the cutlery at me off the tables. Not because they were upset at me, but because they were upset that no one ever shared this with them. And so just, keep your daggers on the table. Okay, we're going to compare a typical traditional investment to life insurance, to whole life insurance. So this is, let's say, a mutual fund, a segregated fund. It is an investment portfolio. And you're investing $1,000 a month, and that's going into the investment, and you're doing that for 20 years. So over that 20 years, it grows to a certain amount, and by the way, I'll set this up too. This is a very specific example. In this example, we're saying this person is going to invest money and use that to supplement their retirement when they're retired. So at age 71, they take out over a period of 15 years. Why are we saying 15 years? Because we're timing this to supplement someone's retirement prior to their passing. And the average age in Canada for passing is about 86. So we'll say from 71, add 15 years, there's your 86 years of age. So from age 71, they start withdrawing the maximum they can withdraw over a 15-year period, and that comes out to $490,000. Then they pass away, and also they've expired their entire portfolio, and there's no money left to go to their beneficiaries. They've used up all their money. Okay, so you've got that in your mind. Typical type of investing, right? Okay, let's look at it using life insurance instead. Life insurance, that should say investment portfolio, should say life insurance. Same amount of money going in, $1,000 a month, but it's going into a permanent life insurance policy. Same thing, it's called whole life. Remember in the beginning when I told you about term and whole life, it's commonly referred to as permanent protection. So $1,000 a month going into the whole life insurance policy, but inside of the life insurance policy, there's no tax. That's the rules in Canada with the insurance tax law, that money kept and held inside of your life insurance policy has zero tax. Now, over the same timeline, okay, person 71 wants to take out money, same amount of money every year if they want, but it's over a 15-year period. They take out almost $550,000, so a little bit more money than the other example. But then they pass away at age 86. Look at the bottom, you'll notice it's life insurance. So $1.3 million goes to their beneficiaries, to their charity, whatever they think, whatever they like, tax-free. So the question is, side by side, left side is your typical normal investment strategy. The right side is a life insurance. If dollar for dollar, you can use more money and have more money to give to your beneficiaries that you're passing, why would you go with the other side and use a typical investment? Well, the reason for that is because it's insurance. You have to continue to pay it. So you have to make sure you have sustainable income, you've got money to continue. If you stop paying, that's not good for you, right? You have to always, it's like, think of it like a mortgage. You got to always pay it. So some people are not in a position that they feel like they can commit to that kind of thing. And then other people are not healthy enough to have insurance. But if you are, and you have sustainable income streams, and you have cash available to you, then this is the thing you ought to be considering. And especially now that that the interest rates are going up, that we should see cash values continuing to go up. It's really an exciting time to be in whole life insurance. Okay, to begin doing this, what you really need is a financial plan. I include this in every single video, as you know. It's seeing the outcome of your planning decisions before you commit to them. It's so important that you get a financial plan done before you jump into this, because it's just useful for you to know exactly what you're trying to achieve having life insurance. And 2 out of 10 people actually have insurance or actually have financial plans, and the ones that do have more money than the ones that don't. That's a fact. It's just a statistical fact. So it's easy to get done, and I encourage you to do that. Again, I want to thank you so much for tuning in today. And I always say and end my videos with, we take care of your wealth management so you can take care of what's most important to you. I firmly believe that it's, spending the time with the people that matter most. And let us take the worry and the anxieties of having to worry about, how are you going to manage your money. Let us take care of that so you can enjoy your life. Have an awesome life. Again, thanks so much for tuning in today. I really appreciate it. If you love this video, please share and like it with everybody that you know. It helps the algorithm and it helps me get the word out to more people. Again, great to see you again. Looking forward to seeing you in the next video. Take care.